Good morning, everyone, and welcome to today's webinar. My name is Alex Paul from InvestorStream, and I'll be your host today. Presenting for you today is AXP Energy CEO Tim Hart and Non-Executive Director Sam Jarvis, who will be discussing the company's recent quarterly activities and other near-term value catalysts. Sam and Tim will give a short presentation on this progress and will be on hand to address any questions following the presentation. You can download a copy of the presentation by navigating to the handouts pane in the control panel. It should also be live on the ASX if you want to get your sourcer from that platform as well. And a copy of the webinar will also be available on AXP's website and social media platforms later today. But for now, I'd like to throw it over to Sam to kick things off. Sam, the floor is yours.
Thanks very much, Alex. And if I can have the first slide with our revenue, which I think would be slide 3. Yeah, that's the one. Thanks to everybody for joining today. And just a recap of the quarterly first, we did just over 7.5 million in revenue, which was substantially up in last quarter's 4.9 million. Customer receipts were just over 6.5 million, up from 4.5 million last quarter. And we had good positive operating cash flow of 1.6 mil, which was again substantially up on the last quarter. So as a result of these, we had cash and cash equivalents of 3.3 at quarter end, which was a decent improvement on last quarter's ending cash of 2.5 million. Annual revenue was almost 21 million compared with the prior year's 4.25 million. And customer receipts were just under 20 million, again substantially up on last year. I would qualify that the annual figures that we're giving are obviously unaudited at this time. So overall, we're very pleased and encouraged with the performance for the quarter, and what you're really seeing here more than anything is the result of an experienced board and an engaged board working closely with a dedicated management team to really improve the way this company is run. And whilst I would admit that we haven't, I guess, had a plethora of news flow each week, I would like to assure everyone here that there is an enormous amount of work going on behind the scenes to really start to extract maximum value from these assets, particularly now that we really have got our arms around the Kentucky asset, the new acquisition, and particularly now that we're generating positive and meaningful financial results. Could I have the next slide, please, Alex? You can see from this slide that even though Q4 production was marginally up on the previous quarter, overall the BOE trend across the financial year production obviously trend is down. And you can plainly see that this is almost entirely due to a drop-off in gas production because NGL production can be seen to be stable and oil production has actually increased across the financial year. And we've said previously, as we've articulated previously, the curtailment in gas production is largely a result of the recurring issues that we continue to experience with our midstream gathering and processing partner. But Tim will go into a bit of detail in the next couple of slides as to how we're dealing with that. But suffice to say that, you know, essentially the gas is there behind pipe. We just can't get as much of it as we would like to market. But as I said, Tim will go into this a bit further. I would just like to expand a little on the purchased NGLs that we mentioned in our quarterly update and how that feeds into revenue. In order to sell the NGLs that we actually produce, or in other words, the NGLs which drop out of our gas, we are required to purchase additional liquids to blend with the produced product in order to transport the final product to market. The amount of produced NGLs during the quarter was around 1.3 million US gallons, and this is obviously cost for us. But at the same time, once the blended product is sold, the complete blended product is sold, it comes back to us in revenue, and that forms part of what you're seeing for the NGL revenue block in Q4. I wish I could say that it's a wash, but at this stage, this is not an economic process. However, we are working very hard on a solution to turn the situation around. We do continue to sell oil inventory down in order to realise that value in this oil price environment. And although we didn't get as low as we wanted by the end of the quarter, it is something that we can continue to pay very close attention to. So overall, with reduced gas production, relatively stable NGL production, and some growth in oil production, revenue growth is primarily being driven by stronger hydrocarbon prices. That's a very obvious fact. But having said that, this is the first quarter where we benefited from the renegotiated gas sales contract that we talked about previously. So we've, been able to deliver improved pricing and margin on sales, and this is a result of us taking quite a strategic approach to pricing and contracting our volume, and not necessarily letting the spot market carry us along. We are starting to see a steady increase in daily oil production, which is now sitting comfortably above 310 barrels a day, and we're very, very pleased with this trend. And sure, it's relatively modest, but it's now a good base for us, and we see a lot of opportunity to increase this further, particularly with an engaged board that's working closely and constructively with management on the ground, and again, particularly with a strengthening cash position. So with that, Alex, can we please have the next slide, and if you can turn it over to Tim.
Thank you, Sam. And thank you to all of our investors for your participation and interest in this webinar today. In the next few slides, I'll go over the progress of the gas sales solution in Colorado, and then discuss the strategy of our near-term growth initiatives. So on September 14th of last year, we announced a heads of agreement to supply gas to Elite Mining so they could set up a Bitcoin mining operation at our Pathfinder site in Florence, Colorado. And although it's been a long time coming, that operation is in the process of coming online. The pictures included show the generators and Elite mobile units on site. We refer to those as EMUs. And we're still in a test phase as we continue to bring the computers online, but currently about 50% of the processors in the first EMU are online, and they're adding to that number daily. Now, we've missed about every timing prediction that we've made on this, so I'd like to refrain from trying to be specific, but we believe the system will be fully online within the next few months. And once the system's fully operational and the gas is moving, we'll have an opportunity to bring the oil production from both the Pathfinder and Amerigo Vespucci wells back online. And one of the questions that we often get, and everybody's very interested in, which is understandable, is how much oil do we expect? And that's a difficult question to answer because we aren't absolutely sure how much the gas production will reduce the pressure in the well. So I'd prefer to report on it as the project progresses, but suffice it to say that we wouldn't be doing this if we didn't expect a decent return. So we're all very excited about the prospects of that. And this solution is material because the field was first discovered back in the late 1800s, and this is the very first gas sales channel that has ever been set up. And not only that, but we've worked through the regulatory process in Australia and the US to get this operation up and running, and there's a lot of value in it, as it means that we have the framework in place to build out the operation in Colorado. And it's no secret that this asset isn't core for us, but it's also worth remembering that there's a very large natural gas resource here, and we continue to assess opportunities for it while still accommodating future scale up from Elite's operations. Slide 6, please. So two of the things that we continue to work on are margin improvements and production volume increases. As discussed previously, in the Appalachian Basin, we have a significant portion of our wells that are contractually dedicated to a single sales channel. And this area is outlined in red in the image to the right. And we often refer to this as the area of mutual interest, which is AMI. And also, as discussed previously, we've had some reliability challenges with the sales channel that led to our decision to only develop outside of this AMI. And as we strengthen the relationship with our midstream provider here, we're working with them to incentivize us to bring on new production through the sales channel once we have confidence that the reliability issues are solved. And so we've agreed in concept that it would be beneficial to the partnership if we had some financial incentive to bring additional production online inside of that AMI. And those discussions are progressing and could be very meaningful long-term for our margins. So in November of this past year, and Sam made reference to this in his opening there, the pipeline provider associated with the sales channel inside of the AMI has increased their scrutiny on the quality of gas sold into the pipeline. And it's impacted our liquid sales in a negative way due to the fact that we're now required to purchase a lower BTU material to blend with our produced liquids. And these costs have increased over time and are more significant in the warmer months. Our team's been working diligently to solve the issue, and we expect to implement our new procedures within the next 30 days. And this will certainly result in much lower costs and improved margins for our liquid sales. And in addition to this, we're also working on a new sales agreement for the gas we produce in the Illinois Basin. The current sales channel also requires blending, as the gas has a high nitrogen content. And so this blending necessitates that we buy additional gas to blend with our produced gas prior to selling into the pipeline. And we've identified several options that will eliminate this need for blending there as well. And so these projects are all very significant, as they'll have a meaningful impact on our profitability through expense reduction. And regarding sales volume increases, there are a number of things that we're working on. We continue to work closely with our midstream partner in the Appalachian Basin to improve the reliability of the sales channel. And we have seen some recent improvements in this, and we believe that they're heading in the right direction by making the right investments and operational changes to the asset. And part of these discussions have surrounded our ability to divert our gas through a different sales channel in the event that the primary sales channel is unavailable. And this solution is extremely complex because it requires contractual modifications as well as infrastructure changes. For example, there are 5 different midstream providers that we're working with to implement this backup solution. However, it'll be a bit of a game changer for us, as we don't have to rely 100% on the single sales channel. We have a portion of our team entirely dedicated to supply all of our wells, to study all of our wells and identify high value targets for us to focus on. And this list grows every day, and these project definitions become more and more mature as they continue to work on them. We have a new recompletion that we intend to start this quarter, and also we're still working on additional pipeline repairs in the KJ field. My confidence level in our team's ability to deliver continues to improve with every project, and I say that because of this. So if you consider the projects that the team has outlined, the KJ field developments, our KJ field production on January 1st of 2021 was 660 MCF per day. Today, it's 1,075 MCF per day. So they identified KJ as a field that we could get some additional production out of. They've executed against their plan. Not every single thing that we've done in that field has hit, but there have been plenty of things that have. And as a result, we're steadily growing production in that field. We've done some discussions and some releases on the DPI 2605 well. And so you're all probably pretty familiar with how that well has been a success. The only other thing is the 2604, the DPI 2604 well. That well didn't meet our predictions, but is a producer. And we certainly didn't strike out. The last I saw, it was making about a barrel of oil a day and 50 to 80 MCF per day of gas. So it does contribute. Not a barn burner, but also not a dry hole. My point in saying this is that, these are really the only 3 projects that the team has presented for execution, and all of them have delivered to some degree. So as you know, we've been primarily focused on developing outside of the AMI and the Appalachian Basin. We have a list of 32 high-value targets that we're currently selecting from, and let me be clear that these 32 are part of a list that is much larger, much larger, greater than 300 wells. The 32 are prioritized as the 32 best opportunities that we have for production enhancement outside of the AMI. And I'll finalize this point by telling you that the first 4 wells on this list are not related to the DPI 2605 success. That one is priority number 5 on the list. And what that means is that the team feels very strongly that we've got a better opportunity for production enhancements by completing these other 4 wells that are located in the KJ field. And I say that because the DPI 2605 was pretty good, but as I mentioned, the team feels that we could do even better with these other 4. Slide 7, please. So the last slide just kind of summarizes what we've discussed and outlines the potential near-term value catalysts. We have the reserves report for 2023 that's currently being worked on. The new sales gas contracts associated with the gas in the Illinois Basin and potentially for any new gas introduced into the AMI. We have the work still ongoing to connect new wells in the KJ field. We're also continuing to work towards leasing opportunities in areas that we have confirmed are favorable for development. Solving the blending issue for the NGLs, which we've discussed. And the system reliability improvements that we're working on with our midstream partner in the AMI. And once this issue is solved, it opens up a huge opportunity for additional well development inside of the AMI. And remember that we're attacking the resolution of these issues in 2 different ways. Number 1, we're working with the midstream provider to improve the reliability. And number 2, we're building a backup plan, both of which are progressing nicely. And with that, I'll turn it back over to you, Alex, for the Q&A portion of the discussion today.
Thanks, Tim. So the first question that's come through, Tim, I'll address this one to you if I can. Just to start, is AXP actively talking with other crypto mining companies about gas flaring opportunities?
Yeah, so this is an interesting question. Although the fall in crypto has impacted these discussions to some degree, we are still having them with multiple companies. And I will note that many oil and gas companies have discussed doing this, and we really haven't seen a lot of success stories. So the fact that our Colorado operation is coming to fruition is a very good thing. And one of the things that I like really the most about Elite is that if you dig into their model, it's to make money by being able to process in times when most others can't. And they're certainly being tested and still growing, which is a pretty good sign. So I would anticipate that that relationship with Elite will continue to grow, but we do still have other opportunities that we're looking at with other crypto companies as well.
Thanks, Tim. This one's for Sam. Sam, once you're able to pump oil from the AMI field in Colorado, has there been any discussion of using the profits from the oil production, otherwise null and void if not for gas flaring, to fund a share buyback program?
Thanks, Alex. Yeah, we've talked about, we've had this question before in various forms. I mean, we want to do whatever we can to return value to shareholders. I mean, that's why we're all here. And that could be done by way of buybacks or dividends or some other mechanism. But it's something, as we've said in the past, it would need to be sustainable through time. You know, it's something we need to, build up to. Right now, today, we've just gotten our arms around the acquisition, and that's been a complex challenge, and we continue to iron out the issues. But we've now delivered a position of relative health compared to, say, a year ago. And whilst we're generating cash, we need to, our focus is really to grow production, as we've said. So, as we've said in the past, returning value in one of these ways is the ultimate driving vision of the company, but I wouldn't say we're quite there yet.
Okay, Sam. So apart from the share price, does AXP currently check all the boxes necessary to uplist the OTCQB?
Yes, we've done a lot of work in that, and yes, we do. It's the only issue, obviously, we have, which we highlight what was a question previously, was the share price. The share price needs to trade at or above a cent continuously for 30 days for that to happen. And when that happens, we will immediately act on that because we put a lot of work into it.
Thanks, Sam. So once the share price is at 1 cent, will AXP make it a priority to uplist the OTCQB?
Yeah, as I've just said, it needs to trade continuously at or above a cent for 30 days. But yes, definitely a priority.
And just another corporate one for you, Sam, to finish. How many stock options remain on the books?
All our options are at half a cent exercise. We have 211 odd million expiring 20th of April 2023 and a further 95 million expiring 20 October 2023.
Thanks, Sam. Now, I'll address this one to you, Tim, if I can. Are there any plans for any asset acquisitions in the near future?
Well, that's certainly something that's always under consideration. You know, we review assets all the time for potential acquisition. You know, the last asset that we did was MHP, where we did all of the DD internally mostly, and we've come a long way to stabilize that asset, but still have some work to do. But I think overall we've proven that we can acquire a relatively complex operation, and we can certainly do that again, especially with something simpler. And so that's certainly always on the table, Alex, and we look at things opportunistically.
So, Tim, the PR on DPI 2605 was very strong. What's the status on DPI 2604? Yeah,
so as I mentioned in the discussion, the 2604 didn't meet our internal predictions of what it would deliver from a production standpoint. I will say with that the 2604 was the first well that we did complete. And so we learned a lot of things from the completion of that 2604 that we applied to the 2605, which was a very significant success. And so, you know, the team is looking at the differences in those completions, and at some stage, we will very, very likely go back into the 2604 and modify what we have done. And there's some expectation that the 2604 can produce a lot more than it is today. Although we've got a number of projects on deck that are certainly in front of that.
So, Tim, are there any plans or studies to acquire a new project in or around DPI 2605?
Yeah, you know, there are some questions that we just need to be careful about how much we share, and some questions that, and the reason is because we put ourselves at a huge disadvantage in doing so. And so this is one of those questions. But I will tell you that, you know, anytime we see opportunities to acquire acreage in areas that we know are favorable, we're certainly always looking for those.
So, Tim, can you just provide a bit more detail on the 2 well completions scheduled this quarter? Are those ducks or separate wells?
Well, so these wells are both in the KJ field, and we're going after production behind pipe. So these wells have already been drilled. They are both currently producing today. So technically they don't qualify as ducks because they're producing. But you know, we're basically going to open up these wells in zones that we have logs that show that they will be highly productive as compared to other wells in the area that have done so. They're relatively low cost and high impact operations, but both of them are outside the AMI in the KJ field in producing zones nearby.
So, Tim, will we see a PR on the Elite Mining launch as per the quarterly report? I think some investors are hoping to see an EMU launch and some production increases at Pathfinder and elsewhere.
We've sort of outlined the status of the project in the body of the presentation, and we certainly expect to update the market once it's fully online.
So how's the company progressing on the 4x4 vertical well program?
So since the announcement of that 4x4 vertical well program, the team has uncovered a ton of lower cost opportunities with production already behind pipe. And so the new drills that we were initially looking at have taken a bit of a lower priority. We do have several new drilling locations on our list. The amount of new drilling locations that we would have is astronomical if we were to look at all of them, but we have targeted the lower cost, high impact wells that have already been drilled that have production behind pipe. So we've sort of not delisted that 4x4 vertical well program, but we're migrating a lot of our lower cost opportunities and prioritizing them above that.
So Tim, once the initial generator is up and running for Elite Mining, what milestones have to be hit to expand to more generators? And I guess, sorry, just and further to that, is there a time frame? Do you expect it to be a month or a quarter?
Yeah, as I mentioned in the presentation, also we've missed just about every prediction that we've made for that. There are a lot of moving parts to it, but what I can say confidently is that that project is progressing. We have brought, like I said, about 50% of the processors that are online in the first EMU, and the guys are working to bring additional processors on daily. I suspect that it will be more than a month, but less than a quarter before we have all of the EMUs up and running, and we'll be certainly eager to put some communications out to the market as soon as that project is fully online.
Tim, you've mentioned workovers, new pipelines, tie-ins, recompletions, and newly dug wells. Do you have sufficient state and equipment to handle a number of these concurrently, or are you switching between these different activities as you move staff and equipment around?
Well, we're certainly working with limited staffing to keep our costs down, and we're strategic about how we use that staffing. Our development activities are, we're certainly not outpacing our staff with the development activities that we've got on deck. And, you know, to the extent that's necessary in order to keep ahead of everything, we can bring in contractors and things like that if necessary, if we aren't able to achieve something in the timeframes that we've identified. But for the most part, I think we're in pretty good shape.
So is there any work that you're still outsourcing or hiring out, and how is that impacted by the shortage of resources or workers that we hear about in the oil industry? And what's the biggest need that you're currently trying to fill?
We've got some long-standing relationships with many of the service providers, both in the Appalachian Basin and the Illinois Basin. And those relationships and leveraging those long-term relationships allows us to, to get what we need done. Every once in a while, we have to call in a favor and get somebody to react quicker than they might otherwise. But fortunately for us, we have the luxury to do that. And one of the things that we're looking at currently, or one of the needs that we have, is to beef up our engineering resources. So that would be one of the needs that we currently have.
So Tim, can you provide any more detail on any mid or downstream improvements? What's worked, what's planned, and a respective timeline?
Yeah, I guess the first one that comes to mind is the relationship with the problematic sales channel that we have in the Appalachian Basin. Our discussions with that midstream provider have been very favorable, and they've allocated additional capital and additional operational activities and changes to their processes that are having a material impact on that sales channel. Now, it takes a little while to architect these solutions and actually get them in place. just to give you an example, if you said that you were going to go put a compressor in line, there is a lot associated with that. You've got to get approvals and permits from the state. You've got to establish the contracts with the compressor provider. You've got to actually get it moved in and get it plumbed up and online, and those things can take 90 days and sometimes 4 months. So we've been working with those guys to do everything they can to move things as quickly as possible. They have installed a booster already, and that booster is to be brought online any day now. There's a compressor move that's scheduled that we expect to pay dividends in the wintertime. Many of you might remember that a lot of the outages that we experienced with the midstream, it was in the winter this past year, and so the colder days have a negative impact on some of the pipelines. And then in addition to that, they're adding some equipment to dry out the gas that runs through the pipeline to further insulate us or ensure us from freeze-ups in the winter. So all of those things are progressing, and all of them will be completed before the cold months hit this year. The other thing I want to mention is that not only will they impact reliability, but there is some expectation that it could have a positive impact on the production volumes as well as you draw down the pressures in the lines. So.
Thanks, Tim. Yeah, you mentioned the cold weather, and we had a question come through specifically about the weather in Colorado. Are you anticipating any potential weather issues in the winter months? And more broadly, how do you plan for that?
Yeah, so there's a material difference in the complexity of the system that we have in the Appalachian Basin versus the system that we have in Colorado. The mining operation in Colorado sits right on the well pad. And so the amount of pipe that's required in order to service that mining operation is much, much smaller, to the extent that, it's feet rather than hundreds of miles, just to give you some sense for that. So much easier to deal with cold temperatures in Colorado with hundreds of feet rather than hundreds of miles of pipeline. We did run a long line from the Amerigo Vespucci well down to the Pathfinder site, but by long in Colorado, we're talking about 1,000 feet versus what we'd be looking at with a more complex system in the Illinois or in the Appalachian Basin. So materially different.
Thanks, Tim. And can you provide a longer term perspective of the company trajectory and I guess the company's overall business plan? We're talking acquisition, scaling, adding headcount, accelerating workovers, tie-ins, ducts and vertical wells. Can you just provide us with a bit of a longer term view of the company's trajectory?
Well, I mean, if I'm being very honest, the sky's the limit here. If you look at our existing well portfolio and all of the opportunities we have with that well portfolio. Well, let me back up, Alex, before I say that. We had an objective to shift gears and put a suite of assets together in an oil and gas friendly basin that had low-cost development opportunities, and we did just that. We put MHP together, we put Trey together, we acquired the other 50% of Kentucky Exploration, and we put that together. And so now we're all one company now called AXP Energy Inc. over here in the U.S. And along with that, we inherited, a number of challenges that we needed to solve. I mean, anytime that you get a new suite of assets that's extensive as that, and we're talking about 1,500 wells, there are plenty of things that you need to know in order to improve them. There were some long-term contracts that that we have that we're working to improve upon. There were some challenges that we had in terms of learning the wells and learning the different fields that those wells are in, and we had to build a team around that so that team could understand and further develop those. And so, we're really just now solving some of these very, very difficult problems that we have that's going to have a material impact on the profitability and the margins that we're seeing with this asset. Once we do that, my expectation is that we will turn our attention to having a much more aggressive approach at developing the production inside of these assets. Right now we're primarily looking at projects that are low cost, very, very high impact projects that are going to have a significant impact in the near term on this development. But the issue is there are so many of those that, if we put a serious concerted effort into doing those projects at a scale that is possible, this company is going to be materially different. And my intent right now is to show the shareholders that we've got a handle on these assets that we've put together, and give samples of these well workovers and well recompletions that we have. And although we have one DPI 2605 to hang our hat on and one KJ field improvements to demonstrate that success, we're going to keep doing that. And what is going to be very, very evident is a pattern of success on a well by well basis. And once enough of those are done, it's going to be pretty easy to see how that could scale. So with the existing asset, Alex, I think that is the key takeaway. In addition to that, we're in a basin that has a whole bunch of MHPs just sitting there. And so I think that once we demonstrate how much success we can have with the assets that we've got, the sky's the limit on how we could grow the company right here in the basin.
Fantastic, Tim. And look, quite a in-depth answer. So that's probably all the time that we have today. Thank you all for joining me. I'd also like to thank both Sam and Tim for presenting and taking the time to answer some questions. Thank you for the high level of questions. We were inundated with questions today and prior to the webinar as well. So apologies if we didn't manage to get to your question. But again, it shows the high level engagement among the AXP shareholders. As I mentioned before, a recording of the webinar will be on AXP's website and social media platforms later today. Tim, before I let you go, do you have any final comments to leave with us today?
I want to express my sincere gratitude to the AXP team, all the way from the guys in the field, the management team, as well as our board. Everybody that is associated with this company is 100% bought into its success. And the results that you're seeing with this quarter are a testament to that. And so I'm sincerely grateful to everybody involved. In addition to that, what we're doing would not be possible without the confidence of the shareholders. I will say, and my guys hear me say this from time to time, the path to success is not always a straight line between point A and point B. In fact, I've never ran into such a situation, and this is no different. No one saw blending coming, or no one could predict the reliability deficiency that we saw in the winter. But we're solving these problems, and through those resolutions, we're building a solid foundation that will support continued growth with the company. So thank you to the shareholders for your continued confidence in us. We have a lot more to go.
Fantastic. That wraps it up for us here. Thank you, everyone. Have a great day.
Thank you, Alex.